What I'm about to show you has never happened in modern silver markets. We are exactly 9 hours away from the single biggest structural shift in global silver trade in over 40 years. And most people have no idea what's coming. Right now, as I'm recording this on December 31st, 2025, silver is trading around $72 to $75 per ounce on COMEX. But in Shanghai, physical silver is changing hands at $82 per ounce. That's a $10 premium, a $10 gap between paper and physical. And in exactly 9 hours, at midnight Beijing time, China's new export licensing regime goes into full effect. Only 44 companies will be allowed to export silver from China. That's it. 44 firms controlling 121 million ounces of annual exports. That's 15% of the entire global supply. But here's what nobody's talking about. This isn't just about export controls. This is about the complete breakdown of the paper silver market. And the data I'm going to show you proves it beyond any doubt. My name is John, and if you're new here, we don't do hype. We do data. We follow the money. And today, the money is screaming one thing. The silver market is broken. Let's break it down. Okay, let's start with the headline number that everyone needs to understand. According to Reuters' year-end commodities report published just hours ago on December 31st, 2025, silver gained 161% in 2025. Let me repeat that. 161% in a single year. This is not my opinion. This is not speculation. This is official data from one of the most respected financial news sources on the planet. Now, let's put that in context. Gold, which everyone talks about as the safe haven asset, gained 66% in 2025. That's impressive. The S&P 500, which had a phenomenal year, was up around 17%. Bitcoin, depending on when you bought it, was somewhere in the mid-range. Copper, driven by AI infrastructure demand, was up 44%. But silver? Well, 161%. It absolutely demolished every other major asset class. Now, here's where it gets interesting. Let me show you the actual price action, because this is where the story really comes together. On January 1st, 2025, silver opened at $28.92 per ounce. Let that sink in. Less than a year ago, you could buy an ounce of physical silver for under $30. Fast forward to late November and early December. Silver started breaking through resistance levels. $60, then $65, then $70. The momentum was building. Industrial buyers were panicking. Retail stackers were piling in. The Reddit crowd was back. The silver squeeze narrative was gaining traction again. Then, on December 23rd, 2025, silver broke $71 per ounce. December 24th, Christmas Eve, it hit $76. December 27th, we saw an absolute moonshot. Silver peaked at around $84 per ounce intraday. That was the all-time high for 2025. An absolute historic moment. But then, the rug pull happened. December 29th, Monday morning, silver crashed 8.7% in a single session. It went from around $77 to close near $69.86, the biggest one-day drop since February 2021, and the financial media immediately jumped on it. Silver rally over. Bubble burst? Speculators getting crushed. But here's what they didn't tell you. December 30th, Tuesday, silver rebounded 11% in a single day, from $69 back up to $77.37 at the close. One of the sharpest one-day gains in silver history. And then today, December 31st, as I'm recording this, we're seeing another pullback of around 5% to 6%, sitting in the $72 to $75 range. So what's really going on here? Is this a crash? Is this a correction? Or is this something completely different? To answer that, we need to look at what's happening behind the price action. And that's where the Shanghai inventory collapse comes in. Let me show you a number that should terrify anyone who understands supply and demand. The Shanghai Futures Exchange currently has 715 tons of silver in registered inventory. 715 tons. Now, if you don't follow silver markets closely, that might not mean anything to you. So let me give you the context. Back in 2020, during the pandemic, Shanghai had over 5,000 tons of registered silver inventory. That's more than 7 times what they have today. Let me say that again. In just 5 years, Shanghai's silver inventory has collapsed by 86%. 86%. From over 5,000 tons down to 715 tons. Where did it go? It got consumed, destroyed, used up, turned into solar panels, electric vehicles, smartphones, medical equipment, semiconductors, 5G infrastructure, AI data centers. All of these technologies require silver. And unlike gold, which sits in vaults and gets recycled over and over, silver gets consumed. It's gone. It's not coming back. Let me break down the industrial demand so you understand the scale we're talking about. Every solar panel uses approximately 20 grams of silver. In 2025 alone, the solar industry consumed an estimated 6,028 metric tons of silver. That's 194 million ounces. And solar demand is projected to account for 50% of total silver demand by 2030. Electric vehicles. Every EV uses between 25 and 50 grams of silver in its electrical systems, battery management, and charging infrastructure. The EV market is growing at a compound annual growth rate of 3.4% through 2031. By 2027, EV demand for silver is expected to surpass internal combustion engine demand. Smartphones, data centers, 5G towers, medical devices, military applications. All of these sectors are consuming silver at an accelerating rate. Now, here's the kicker. In 2025, total industrial demand for silver was approximately 680 million ounces. That's roughly 50% of all silver demand globally. And here's the problem. Mine production has been flat or declining for the past decade. Most silver is produced as a byproduct of copper, lead, and zinc mining. You can't just turn on a silver mine when prices go up. It takes years to bring new production online. And most of the easy-to-mine deposits are already tapped out. So we have surging industrial demand, flat mine production, and collapsing inventories in the world's largest physical silver market. This is not a speculative bubble. This is a fundamental supply crisis, and it's been building for years. But wait, there's more. Because what's happening in Shanghai is only half the story. The other half is the COMEX, the paper silver market in New York, and that's where things get really interesting. All right, this is where the manipulation narrative starts to make a lot more sense. Right now, as I'm recording this on December 31st, 2025, COMEX silver futures are trading around $72 to $75 per ounce. That's the official price. That's what you see on Bloomberg, on Kitco, on all the financial news websites. But here's what they don't show you. In Shanghai, physical silver is trading at approximately $82 per ounce. That's based on the Shanghai Futures Exchange spot price converted to USD. That's a $7 to $10 premium over COMEX. Let me be clear about what this means. If you want to buy physical silver in Shanghai right now, you have to pay $82. But if you sell a COMEX paper contract in New York, you get $72 to $75. That's a massive premium for physical over paper. And it's not just Shanghai. Let's look at physical premiums around the world as of late December 2025. Dubai, physical silver trading at approximately $96 per ounce. Russia, $98 per ounce. Australia, $93 per ounce. Canada, $89 per ounce. COMEX paper price, $72 to $75 per ounce. Do you see the pattern? Physical silver is trading at a massive premium to paper silver all over the world. The premium in Dubai is $21 to $24 per ounce. That's a 28% to 32% premium over COMEX. Now, in a normal functioning market, this shouldn't happen. If silver is $75 in New York and $82 in Shanghai, arbitrage traders should be able to buy in New York, ship it to Shanghai, sell it for a $7 profit, and pocket the difference. That arbitrage should close the gap almost immediately. But it's not closing. The premium has been widening, not narrowing. Why? Two reasons. Reason number one, physical silver is increasingly difficult to move across borders. Shipping times, customs delays, insurance costs, and logistical bottlenecks mean that arbitrage is slower and more expensive than ever. Reason number two, and this is the big one, China's export controls. Right now, as of today, December 31st, 2025, you can still technically export silver from China if you have the right paperwork. But in 9 hours, at midnight Beijing time, that changes. The new export licensing regime goes into full effect. And that brings us to the next segment. This is the moment we've been building toward. In exactly 9 hours from when I'm recording this, at midnight Beijing time on January 1st, 2026, China's new export licensing regime for silver goes into full effect. Here's what that means. According to a Reuters report published on December 30th, 2025, China has named 44 companies that will be allowed to export silver during 2026 and 2027. That's it. 44 firms. That's only 2 more companies than were licensed in 2025. These 44 companies will control approximately 121 million ounces of silver exports per year. To put that in perspective, that's roughly 15% of global silver mine production. China is one of the largest silver exporters in the world, and now all of that export flow has to go through 44 state-approved companies. Let me be very clear about what this means in practice. If you're an industrial buyer in the United States, Europe, or Japan, and you need to buy physical silver from China, you can no longer buy from independent traders, small exporters, or regional dealers. You have to go through one of these 44 licensed firms. And here's the kicker. These aren't just any companies. These are large, state-aligned firms with at least 80 tons of annual capacity. This means China has effectively nationalized its silver export supply chain. Now, why would China do this? Officially, the Chinese government says it's about managing critical metals for national security and industrial support. This is in response to U.S. chip restrictions and the broader technology trade war between the U.S. and China. But here's the real reason. Silver is now on the U.S. critical minerals list. It's classified as a strategic resource. And China knows that the West is desperate for silver to build solar panels, EVs, semiconductors, and military systems. By controlling the export flow, China can, number one, ensure domestic supply for its own industrial needs. Number two, drive up global prices and profit from the premium. Number three, use silver as a geopolitical weapon in negotiations with the US and Europe. And here's the scary part. Elon Musk, yes, Elon Musk, publicly warned about this on Twitter back in late December. He said, and I quote, "This is not good," in response to news about China's silver export restrictions. Why would Elon Musk care about silver exports? Because Tesla needs silver for its vehicles, SpaceX needs silver for its satellites. His companies are massive industrial consumers of silver, and he sees the supply chain risk that's coming. So what happens starting at midnight tonight? Here's my prediction. In the first few days and weeks of January 2026, we're going to see, number one, Shanghai premiums widen even further as domestic Chinese buyers realize they can no longer easily export silver. Number two, COMEX inventories start to drain as industrial buyers scramble to secure physical supply outside of China. Number three, spot prices decouple even further from paper futures prices. Number four, volatility explodes as speculators, industrial buyers, and sovereign funds all try to position themselves for the new regime. This is not a drill. This is not hype. This is policy. And policy drives markets. Now, let's address the elephant in the room, the volatility we've seen this week. Monday, December 29th, down 8.7%. Tuesday, December 30th, up 11%. Wednesday, December 31st, down 5% to 6%. A lot of people are looking at this price action and saying, see, the silver rally is over. It was all speculation. The bubble popped. But here's the reality. This volatility has nothing to do with fundamentals. Let me explain what actually happened. On December 27th, 2025, the CME Group, that's the Chicago Mercantile Exchange, which operates the COMEX futures market, announced that they were raising margin requirements for silver futures. Specifically, the initial margin for March 2026 silver futures was increased from $20,000 per contract to $25,000 per contract. That's a 25% increase. Now, if you're not familiar with futures trading, let me explain what this means. When you trade silver futures, you don't have to put up the full value of the contract. You only have to put up a margin, a percentage of the total value. That margin acts as collateral. When the CME raises the margin requirement, it means traders have to put up more cash to hold the same position. If they don't have the cash, they have to liquidate their positions. They have to sell. And that's exactly what happened on Monday, December 29th. A wave of forced liquidations hit the market. Leveraged speculators who were long silver had to dump their contracts. That created a cascading sell-off. Prices plummeted 8.7% in a single day. But here's the thing. That selling pressure had nothing to do with physical silver demand. Industrial buyers didn't suddenly stop buying. Solar panel manufacturers didn't cancel their orders. The Shanghai inventory didn't magically refill. The selling was purely a function of leverage and margin. It was technical, not fundamental. And that's why we saw the 11% rebound on Tuesday. As soon as the forced liquidations were done, buyers stepped back in because the fundamentals didn't change. And today, December 31st, we're seeing another pullback. But again, this is end-of-year profit-taking. It's low liquidity. It's what traders call a ghost week, the period between Christmas and New Year when trading volumes are thin and price action can be erratic. So here's my message to anyone freaking out about this week's volatility. Ignore it. This is noise. This is leverage. This is not the story. The real story is supply, demand, and China's export controls. And that story is bullish for silver in 2026. All right, let's talk about what's coming in 2026. Based on everything we've covered, the 161% gain in 2025, the 86% inventory collapse in Shanghai, the $10 premium between physical and paper, the China export licensing regime, and the ongoing industrial demand surge, here's my outlook for silver in 2026. Scenario number one, conservative case, $100 to $125 per ounce. This is the scenario where things continue on their current trajectory. Industrial demand grows steadily, COMEX inventories slowly decline, Shanghai premiums stay elevated but don't explode, In this scenario, silver grinds higher over the first half of 2026 and reaches $100 to $125 by mid-year. This is the most likely scenario in my view. It's based on fundamentals. It's based on supply and demand. And it assumes no major black swan events. Scenario number 2. Aggressive case, $125 to $150 per ounce. This is the scenario where industrial buyers start to panic. Maybe a major solar manufacturer announces they can't secure enough silver to meet production targets. Maybe a semiconductor fab in Taiwan has to shut down production due to silver shortages. Maybe the US government announces a strategic silver reserve to support domestic manufacturing. In this scenario, we see a sharp acceleration in buying. COMEX inventories drop below critical levels. Shanghai premiums widen to $15 to $20 per ounce. And we get a FOMO-driven rally that takes silver to $150 or higher by Q2 2026. I'd put this scenario at about a 30% probability. It's less likely than the conservative case, but it's definitely possible. Scenario number 3, extreme case, $200 plus per ounce. This is the scenario where everything breaks. COMEX defaults on physical delivery. Shanghai stops exporting entirely. A major bank or bullion dealer fails due to short position exposure. In this scenario, we see a full-blown silver squeeze. Prices go parabolic. We hit $200, $300, maybe even higher. I'm not saying this will happen, but I'm saying it can happen. And if it does, it will make the GameStop squeeze look like child's play. Because silver is a real asset with real industrial demand. This isn't meme stock speculation. This is supply and demand at the most fundamental level. So what should you do? I'm not a financial advisor. I can't tell you what to do with your money. But I can tell you what I'm watching in the first few weeks of 2026. Number 1, Shanghai premiums. If they widen above $15 per ounce, that's a major red flag. Number 2, COMEX inventories. If registered inventories drop below 400 million ounces, that's critical. Number 3, industrial news. Watch for any announcements from major silver consumers about supply shortages. Number 4, Federal Reserve policy. If the Fed signals more rate cuts, that's bullish for precious metals. Number 5, China export data. Watch the first batch of export data under the new licensing regime. Those are the 5 indicators I'll be tracking closely, and I'll be covering all of them in my next video. All right, that's it for today. We are now less than 9 hours away from China's silver export licensing regime taking full effect. If you want to see what happens in the first hours after midnight Beijing time, I'll be releasing a follow-up video on January 1st, 2026 at 1 a.m. Pakistan time. That video will cover the immediate market reaction, the first Shanghai premium data, and what it all means for Q1 2026. If you're not already subscribed, hit that subscribe button and turn on notifications, because things are about to get very interesting in the silver market. This is John, your Asian guy. Follow the data, follow the money, and I'll see you in the next one.